Well, hello and welcome to another episode of the Lending Podcast. We are your hosts here in Austin, Texas. I'm John Burnham, along with Jeff Jones.
Hello.
Thanks for being with us again today. We've got a great topic. We're going to talk about how to access the equity in your home. Now, if you're not a homeowner yet, that's okay. We're still going to touch on a few things that will help you as well. But yeah, this is really for our homeowners out there. We've had a lot of calls recently, a lot of conversations about how to access the equity. A lot of us have a tremendous amount of equity in our homes. If you've owned a home for more than just a couple of years, you've probably seen some significant appreciation. So we're going to touch on that today.
Yeah, I think it's a great topic. And for those that are thinking about buying their first house, I think this is good information too, in the fact that like the year is now 2030. It sounds like a futuristic time frame. That's only 5 years away.
Right. Right.
And you've owned your home for 5 years, and now you're wondering, what do I do with the equity that I've accrued on this? It's worth a lot more than I bought for it, and I've paid my loan down a little bit. So this is good information of when you're feeling like you're house rich but cash poor, and you need funds for something. And we're going to go through different scenarios and tell you what that looks like and the benefits of it. So
yeah, and I'm also going to put a little twist on this. You know, we're here in Texas. We lend primarily in Texas. And we have some of the most challenging home equity laws, I would say, of any state in the union. And I say challenging, they're just restrictive. And so one of the things we're going to talk about today is, yes, how to access the equity. But I'm also going to throw out, if you're not a homeowner yet and you're looking to purchase your first home, consider different down payment options. Consider putting less money down, because I'm going to throw a wrench in some things here. When you put 3% down or 5% down as a homeowner, you have to get to 20% equity in your home before you can access equity in your home. So it sounds counterintuitive, but if you put 20% down on a house, which is a great down payment, you're not able to actually access the equity in your home, even though you have 20% equity there. And so we're going to talk a little bit about what are the benefits of putting 5% down or 10% down, right? So hang on to some of that cash because it's tougher to get to that equity. And then for our homeowners out there that have 40, 50, 60% equity, you have a big chunk, hundreds of thousands of dollars perhaps that are available. What are the best options on how to access it?
yeah, I love it.
Yeah.
I love it. It's also a fun time because as we get our, tax assessments for the county, and you're coming in like, oh my gosh, they're assessing my property for so much more than I bought it for. Well, the reality that means too, that when you go get your appraisal, because when we do our, second liens or our cash out refinances, which we'll be talking about, there's an appraisal process. Sometimes there's waivers, but in the reality is it's going to have an appraisal value, right? And if you're looking at that tax assessment and you're like, holy cow, it's $100,000 more than I bought it for, you don't have to worry that an appraisal is not going to value it for that, because the county is acknowledging that number. So it's almost like worst case scenario, we can at least hit that number.
That's true. Yeah, most of the time we see the county tax appraisals are even on the conservative side, even though a lot of us fight our county values, which we talked about that in one of the prior episodes here, is fighting your county appraisal. The county appraisal is not what an independent market assessment appraiser is going to value your property at. So your property might be taxed and valued at $400,000 as far as the county is concerned. It might be market value $450, $420, $500, who knows. And so when we're talking about accessing the equity in your home, we're really talking about an independent third-party appraiser hired by the mortgage company, right? Contracted by your mortgage company to assess the value of your home. And then with that appraisal, we can lend up to 80% of that value in Texas.
Right, so it's not the 80% that you purchased it for.
That's right.
It's the 80% of the new appraisal value today.
Yep.
That when you start your contract to refinance. Well, good.
And so a lot of our clients out there, if you've owned a home for any number of years, you probably have a really low interest rate, right? We're seeing this and we're having this conversation, rates are elevated compared to where they were 3 or 4 years ago. And that's true. But really in the last 3 years, and we've talked about this quite a bit, rates have kind of stayed in this sort of 6.5 to 7.5 range, for the most part. Yes, there's been a little some lower rates available, and there's some higher rates available. But for the most part, we're kind of hovering in that high 6s to low 7s. And so as a homeowner out there, if you have an interest rate that's lower than that, let's say 3 or 4%, some of the discussions we're having is, well, why would I sell my house and go buy something else at 7%? And there's tax benefits and there's reasons to do that, which we can take a deeper dive on. And for some folks, it's the I have to move, maybe not I want to move, but I really have to move. So there's the want tos and the have tos out there when we're looking at folks that are moving. But if you're not going to sell and buy, you want to access the equity in your home. That's really what this episode's about. And so we're going to touch on the 3 types of home equity loans. Okay, there's actually 3 types in Texas. There's a fixed rate second lien. So this is really about leaving your first mortgage in place, right? So you have this really good interest rate. You probably refinanced, when COVID hit, as everybody did for the most part. And we don't want to get rid of that first mortgage rate. So we're going to borrow a second mortgage, right? Home equity loan or home improvement loan at a fixed interest rate. So that's option 1, is a fixed rate home equity second.
And that's where you get a lump sum.
That's right. You're going to get a lump sum. You're going to get it at closing, right? Could be 100,000, 50,000, whatever, right? The maximum that I've seen out there is about $500,000. It's about the maximum. There may be some exceptions to that, but most of the banks that we work with have like 250 to 500,000 is kind of the upper end range.
So you're still keeping your first loan.
Yeah.
That doesn't change anything.
That's right.
It doesn't impact that first loan at all.
Not at all.
You're just getting a second loan that can possibly go up to the 80% of whatever. So say you have 60% there on your first, so you have a 60 loan to value ratio.
Right.
Then you can do another 20% fixed rate, just cash up front at title closing.
That's right.
Okay.
And so that's a fixed rate. You get all the money at closing. Then the second form of accessing equity through a second lien is something called a home equity line of credit, or a HELOC. And so you hear that out there in the marketplace. And so what a home equity line of credit is it truly is an open-ended line of credit. Obviously, it has a maximum amount you can draw. But when you close on that, let's say it's a $200,000 line of credit, well, you don't have to access any of it up front. You can just have it, and if you have home improvement projects or if you have other debt that you want to pay off, you can have this maximum line of credit, but only pull, $5,000, $10,000, whatever you need as needed. Now, those are generally variable interest rates. So that also comes with some analysis as a homeowner of your tolerance of risk, right? Would you rather have a fixed rate? Would you rather have a variable rate? I would make the argument right now that having a variable rate is an okay thing to do because we've seen rates stay elevated for a couple of years. So if we have that forecast that rates will come down, then having a variable rate, your rate will go down when the Fed lowers the short-term interest rates.
Yeah.
Right.
And I think, when it comes to loan size and how much cash do you really need for what you're trying to do? Say, hey, I just really want to pay off my car. I need to pay off a bunch of credit cards. So maybe the number's like, I need $30,000.
Yep.
A home equity line of credit is probably the best product that matches that because it's got the lowest amount of fees up front and you're only drawing, like you said, what you need.
True.
And then you pay it back as you go, right? So you want to put a big lump sum towards it. That brings down, how much you're paying in interest because the balance is low now. So it's always being re-amortized, right? So it's not like a traditional mortgage. You're not going to get that. It's almost like a credit card, but with a different structure,
Yeah.
And it's holding your house as collateral.
Yeah, and the interest rates we're going to touch on, maybe a little more in depth, but they're generally speaking they're around the prime rate. So prime rate right now is 7.5. So you might see some stuff in the high 6s, you might see some stuff in the low 8s, mid 7s, but that's kind of where those home equity loans and lines of credit land. And keep in mind it's a higher risk for the bank because they're in second lien position, and so. The first lender that has your first mortgage, their lien position takes priority. So in the event that the house had to be foreclosed on or distressed sale, that second lien lender is really going to get they're going to draw the short stick on that, right? They may not even be paid back in full. So they have a higher risk, and lending is all about risk. Rates are all about risk, and so the higher the risk, the higher the interest rate relative to the market. So that's the second option. So a fixed rate home equity loan or a variable rate HELOC, those are both in second lien position behind your first mortgage, okay? Or there's something called a Texas cash out. Now the Texas cash out, we were doing a ton of these in 2020 and 21 because we may have had a homeowner who was at 5% interest rate. They could refinance, cash out, and lower their overall rate on their whole loan. And in some cases, you could get cash and lower your monthly payment.
It was crazy.
Bonkers.
Yeah.
And so, we're not doing as many or seeing as many of those because, again, if you've got a 3 or 4% rate now, you'd be cannibalizing that loan and putting in a new rate of, say, 7% on the entire mortgage, okay? But there are some benefits to that. I've had clients that did not have a mortgage from 2020, right? They had a higher interest rate loan from a few years ago, and we were able to do a cash out and lower the overall rate. And the other thing you got to keep in mind too is the blended rate, right? So
yeah, let's talk about blended rate.
The blended rate on all your debt. And so this is something I think that gets missed because if you're at, yes, 3% on your mortgage, that's incredible. But if you've got 40, 50,000, 75,000, I've even seen upwards of 200,000 in unsecured credit card debt at 28% or 33, whatever, that blended amount, I owe 200,000 on my mortgage at 3%. I owe 200,000 on credit cards at 30%. Well, guess what? You're paying 16.5% interest.
Right.
Blended, right? Half of your debt is at 3, half your debt's at 33. And so, or 30. And so that's what we need to look at holistically is can we use the equity to wipe out some other debt or pay for some home improvement projects? Maybe you're planning on selling your home in a year, right? And it's about, hey, I want to prep this house and get it ready to put on the market. So there's lots of different uses for those loans.
I like that. I'm glad you brought that blended concept up. When a lot of people are thinking of their mortgage, they're just thinking of that piece. Instead of thinking your whole, family structure picture that you're in. And so if you, like you said, you have other debts out there that are higher than what an interest rate you can get on a mortgage or second lien, why not consolidate into a lower rate, lower monthly payment, save all that interest expenses? You'd be surprised how much you can save a month.
Well, and the tax benefits. So
right.
So you turn a cash out loan on your homestead that pays off unsecured debt that now becomes secured by your real estate. You can write off all that interest,
right.
And it could impact your tax refund. So that's gravy, deal. But it could be thousands of dollars.
Yeah.
A year.
So if you're listening to this and you're in that boat of, man, I have a lot of other debts other than my mortgage, talk to a loan specialist. See what this consolidating your debt looks like into your home because it might be a huge win. For you.
Yeah.
So I like that. Now, we've been talking about mainly primary homes, like where you live and your own debt.
Yeah.
What about like people that have second homes or investment properties?
We're seeing an uptick in activity and conversations about those as well. And so there are some really aggressive loan programs right now for our investor clients. And I would say second homes too.
I've been getting the emails every day.
Yes. And so we've touched on this.
Yeah.
It's a 4-letter acronym, DSCR, which is a debt service coverage ratio loan. It's almost like a commercial loan, the way it's underwritten. And it's designed for our investors. It could be Airbnb properties too that are used for rentals. And we're really underwriting the cash flow of the property. We're not really underwriting the borrower. Yes, we're looking at credit, and yes, we're looking at property equity, but we're not really looking at tax returns. We're not really looking at bank statements. We're not
the income, the ability to repay is what we have to call that kind of clause. The income calculation is based on the property bringing in the income, not the borrower.
Yes. Okay. And so that's a way to access home equity from an investment property or a second home, and without divulging or having to share and having to comb through lots of tax returns and a lot of income. Because we do have some of our investor clients out there right now that maybe have had a rough patch over the last year or two. Property taxes have gone up. Insurance has gone up. I'm doing a cash out refinance for one of my investors right now who has done really well, maintained an awesome credit score, but when it comes to cash reserves, he just doesn't have a lot of cash reserves.
It's been a tough 2 years.
Yeah, but he's got 8 rental properties.
Right.
He's got tons of. On paper, he's multimillionaire with equity, but just liquid cash right now, he's not in a great spot. And so these investment property cash out loans are a great way to get some reserves, pay down some other debt. I think he was actually going to use some of the money to fix up one of his properties, to sell one, to then free up more cash. So there's just a lot of strategy that we can discuss and look at when it comes to these home equity.
Yeah, and you touched on something briefly there about a lot. When I was in Buffalo, New York, we did a lot of property investments because we were a nonprofit. Shout out 716 Ministries, Buffalo, New York, where we would rehab properties and sell them back to the community. But a lot of times we held them and used them as rentals. So we had the concept that we had to sell properties in order to buy the next property. And actually was good because it allowed the neighborhood to be owned by the actual people that live there. But if you're an investor and you're like, hey, I got 8 properties, and in order for me to get that next one, I got to sell something, you might not have to sell.
Right.
You might, be able to get a DSCR loan on one of your properties or even on 2 of them. And now you got a huge cash reserve, keep your properties cash flowing. So I think it's a great opportunity for people out there. If you have investment properties, you should look into a DSCR refinance.
Yes. And I was at a lunch yesterday with an economic advisor for one of the companies that we work with, and some really interesting stats and data. And one of the things we really looked at were mortgage delinquencies, and we're seeing them at a very low rate right now.
They're less than 1%.
Yeah, it's less than 1%.
Yeah.
Which is of course a great thing, very healthy. However, we sort of can see the writing on the wall. We could see, and this is not doomsday here, but we could see some
strain is happening.
some trending where consumer debt is at an all-time high, right? We've seen car loan delinquencies pick up. We've seen some credit card delinquencies, some data around credit card delinquencies ramp up. And so where's the well that people can go to without cashing out their 401k or cashing out their retirement? And that's through the equity of their property. And quite frankly, if you think about, yes, your interest rate on your mortgage could go up in this instance, but if your overall payments are going down, you can build through that debt snowball practice where you take the monthly savings, put it back towards the mortgage. You can actually pay your house off quicker, even though it's at a higher rate. Yeah. Because you're paying off this unsecured debt that's really not getting you anything. It's empty debt, right?
Right.
Non-collateralized debt. And I'm not talking about like paying student loans off necessarily. If they're at low interest rates, keep that stuff, or a 0% credit card that you just transfer to balance to. I'm talking about that 27.99 for one of the big banks that we all know. And
when you get your monthly statement, you look at like interest charged, and you're like, what?
Yeah, do that comparison. I mean, it's a great exercise. Like, write down your credit card statements, go to the last monthly statement, and then highlight the interest that was paid. And if you're at 27.99, just to give you an example, if it's a $10,000 credit card, that's almost $250 a month.
Yeah.
$250 a month in interest, right?
Yeah.
And so if you have $50,000, that's probably $1,200 to $1,500 a month in interest. And so, that, I guess that conversation that needs to happen is this the right thing for me? And we'll crunch the numbers. And sometimes it's not. A lot of times it is. And it may not even be a product. The product that you need may not be a product that we even have in-house. I've got some partner banks that I work with, and just on a referral basis, and I know that they treat our clients well. And so if it's not a product that we have in-house that really fits you the best, I can call my friends up and say, hey, can you take care of my clients because they need a home equity line of credit? And so a lot of times it is under our umbrella here at Benchmark, but a lot of times, some cases it's not.
Well, I love that about you, and we have that same kind of value of if I know of an affiliate partner or just a friend or just, a banking relationship that has a much cheaper product for the same thing, then we're going to encourage you to go that route, and we'll introduce you. Might not get anything for it, but the home equity line of credits, those get very competitive within your local community. So if you're in Texas and you're in Hays County like me, you might have a great credit union that can provide an amazing HELOC program for people a part of the credit union. Or we have other organizations that are also, like if you're in Williamson County, Travis County, there's a lot of competitive products for home equity line of credit, because the popularity of them is getting a lot bigger, I believe. And it's a great service to the community to provide those from, a credit union or other banks. So
Yeah.
I like them.
Yeah, and home equity lines of credit are niche products for the most part. Not all banks do them. Not all mortgage companies do them. And again, it was for kind of the reason that I touched on, which is they're in second lien position. It's kind of it's a riskier loan for them. Right. So you've got to have a bank with deep pockets that can have those sort of higher risk loans out there. And sort of spread that risk around, through their portfolio. So a lot of the smaller community banks don't do them. The larger credit unions, they do a really good job. I'm a fan for sure of a lot of their HELOC products. So
I might go get one today.
There you go. Why not? Everyone's doing it.
Everyone's doing it. I kind of missed the boat.
No, it's still lots of
I got some
lots
projects
of money
I want to do.
Yeah,
so it'll be good.
Well, you have good equity in your house.
I do.
So yeah. So that's
I like this one.
An overview. Yeah. I mean, we're seeing a lot more and having a lot more conversations about, I want to buy before I sell. How do I need to access the equity in my house so I can buy something else. I need to access the equity in my house to pay off some debt, or I've got surprise expenses that happened, or I want to do home improvement, remodels. And for the same reason that someone may not want to sell their home because they're in a low rate mortgage, which I totally understand, they may want to remodel. They might want to put an ADU in the back, or a accessory dwelling unit.
Little she shed.
Little she shed, little mother-in-law plan.
There we go.
And so there's just 100 reasons to consider accessing the equity. And so we're here to help you navigate through that.
I love it.
Yeah.
So if you're house rich but don't feel rich and you need to figure out how to access equity in your home, we hope this helped you out today. And continue to listen to us here at the Lending Podcast. We'd love it if people subscribe, give us comments, and share it with all your friends and relatives. We're here for you.
You bet. We appreciate you. Thanks for tuning in.